Welcome to Objective 4 in Unit 5 of Accounting 3310. We're in the second half of this objective, ready to talk about the inventory method of LIFO. Here's the basic inventory example that we're going to use to explore the differences that LIFO presents to the other inventory methods. The definition of last in, first out is that the cost of items sold are transferred from the asset account of inventory to the expense account of cost of goods sold, assuming that the newest purchases were sold first and the oldest purchases remain in ending inventory. This method doesn't match many reasonable selling strategies except for the classic dirt pile, but it is another estimate of inventory. When we evaluate this method, it has a high information requirement because beginning inventory can have an additional layer of inventory for each year in a growing business. It tends to be computationally simple, but it's open to manipulation because end-of-period purchases have an immediate effect on income, and because declines in inventory can result in LIFO liquidation. Last in, first out valuation of inventory is unrelated to current value, but current income is matched with the most current costs, resulting in net income closest to an economic increase in wealth. When there are generally rising prices, LIFO results in lower income because LIFO results in lower income than FIFO because lower prices are in ending inventory. Therefore, many manufacturing and retailing companies switched to LIFO during the high inflation era of the 1970s in order to report lower income and to incur lower taxes. LIFO is not an acceptable measure internationally, so multinational companies often use LIFO only for their U.S. inventories. For example, the Russell Company expresses their inventory this way. Inventories of finished goods, work in process, and raw materials are carried at the lower of cost or market, with cost for the majority of our inventories determined under last in, first out LIFO method. Certain inventories are carried under the first in, first out method or the average cost method and were valued at approximately $163 million in 2005 and $158.6 million in 2004. So you see, here's a company that uses LIFO extensively, but also has particular products that use other inventory methods. Here are the LIFO procedures. One needs to gather information about the layers of LIFO in beginning inventory and current year purchases, including units sold and units remaining in inventory. Beginning inventory is typically a layer for each past year. Then we'll allocate the layers or portions of layers to cost of goods sold, beginning with the most recent purchases, and we'll allocate layers or portions of layers to ending inventory, beginning with beginning inventory and the oldest purchases. Perpetual and periodic systems have different LIFO values. Periodic system allocates all goods available for sale during the year between cost of goods sold and ending inventory. A perpetual system allocates cost to cost of goods sold at the time of each sale based on only goods available for sale at that time. Here's an example of LIFO periodic. In our example, we have 4 layers of inventory, including 4,000 units. Cost of goods sold represents items that are taken from for a total of $2,500. The items now are from the most recent layers, so the 1,000 at $9, the 1,000 at $8, and 500 out of the $7 layer are the ones that are considered sold. Ending inventory is allocated the oldest purchases, so it's the 1,000 at the $6 for 6,000, and then 500 out of the $7 items. This gives a price of $20,500 for cost of goods sold and $9,500 for ending inventory. In a perpetual setting, the allocation takes place at the time of every sale based on the goods that are actually available in inventory as of that date. That means that we actually have a different number of goods from cost of goods sold, and it adds up to 18,200. So when we have that sale that's early in January, the goods have to come out of the $6 layer because that's the only layer that exists at that point in time. On February 10th, we've had an additional purchase, and so then the 800 sold in February can come out of the layer at the $7 value. The April purchase is going to be the most recent purchase, which at that time is the $8 purchase, so the entire $8 purchase is sold, and then another 100 is taken from the $7 level, and the December purchase and the December sale is 100 items at the most recent price of $9. This means that as we sell throughout the year, we actually, in a perpetual system, still have some of the $6 items, the $7 items, and some of the $9 items all in our ending inventory. When a periodic system is used with LIFO, then all goods available for the year are considered at the end of the year for division into cost of goods sold, purchases nearest the end of the year, and inventory, the beginning inventory plus purchases nearest the beginning of the year. Thus, goods may be allocated to cost of goods sold that were never actually available for sale at the time any sale was made. In addition, this can encourage end-of-the-year purchases in order to influence expenses. Periodic LIFO has an advantage of having lower processing costs, but it is not representationally faithful and it's easy to manipulate. When a perpetual system is used with LIFO, then only goods on hand are considered in allocating cost to cost of goods sold. This results in higher processing costs, but it's going to be hard to manipulate. LIFO had its origins in an economic environment in which there was rapid inflation. During rising inventory costs, periodic LIFO will produce the highest cost of goods sold and the lowest inventory value because most current purchases are allocated to cost of goods sold. LIFO liquidation occurs when a decrease in inventory levels transfers older LIFO inventory layers to cost of goods sold. This matches very old, out-of-date inventory values with current revenues producing high gross margin when inventory prices have been rising. Income from LIFO liquidation is temporary and cannot be repeated in subsequent periods, so it represents low-quality earnings. Here's a LIFO liquidation example. In this example, there's a significant decrease in ending inventory from one period to the next. Let's say that in 2004, the beginning inventory had 4 LIFO layers, but rather than having a growing inventory during the year, they make some significant strategic changes and they only have 100 units left in inventory at the end of the year. That means that the 2003, 2002, and 2001 layers are all transferred to cost of goods sold. If the company had been using FIFO, then the layer of beginning inventory would have been all purchases from 2003, and ending inventory would have been all purchases from the current year. Notice the difference in prices. In this era of rising prices, the ending inventory layer that's left is products at $2. There are products at $3 and $4 and $5, all of which were sold. LIFO liquidation can occur when strategic changes reduce the needed inventory levels, when downsizing occurs, when producing less occurs because of lower demand, or when drawing down inventory through the year as a temporary measure in order to achieve the income boost of LIFO liquidation before restoring inventory to its usual level. Thus, LIFO liquidation must be examined to identify its source in order to evaluate the company financial position. Here's a comparison of the inventory methods we've studied. Based on the value on the income statement, specific identification is apparently the most accurate match with revenue, but it's also easy to manipulate through the choice of the units sold. Weighted average tends to be very rational and systematic, but it's unlikely to be the best match with revenue. First in, first out represents the worst match between cost of goods sold and revenue, and last in, first out represents the better match between cost of goods sold and revenue. However, it can be easy to manipulate through late purchases if the company is using a periodic system. Now let's think about the balance sheet value. Specific identification, again, tends to appear to be the most accurate. Weighted average has a value that is in between the value used for LIFO and the value used for FIFO, which makes it a good compromise position. First in, first out has a balance sheet value that's nearer to fair value for the inventory. LIFO produces a value on the balance sheet that's farther from fair value. Companies can choose any one of the 4 inventory methods that we've studied, and the method that they choose does not have to be related to the way in which they actually have product flows of inventory. Thus, it becomes an important decision of a company which inventory method they're going to use, and it becomes important for analysts to look at the significant accounting policies of a company to see what inventory method they do use, and to include that information in evaluating both the balance sheet figure of inventory and the income statement figure of cost of goods sold. Thank you.